Thank you very much. Thank you, McFarlane. I must remember to get white shoes. I keep on thinking white shoes is cool. It is so good to be here. Hello. Hey, how nice is it to be together again as an industry? This is what we are supposed to all be about. So it's really good to be here with friends and colleagues. And thank you very much, FIA, for the opportunity to share some thoughts with you. The topic of the whole summit today is the sustainability of underwriting and advice. And I was reflecting that it's actually quite sobering that we should be sitting here today with that as our topic. But then again, I realized that the last 3 years has certainly been the toughest I've ever had in my career, and I'm sure many of you feel the same. So it's right that we're talking about this topic. The topic I've got today, I want to share a few thoughts about how we rise to the challenge together. I'm going to share some thoughts around how we can do things a little bit differently, but there's no doubt that the only way we will be successful is looking at that last point, and that's going to be working together. If I look at the agenda, I do want to get into the world of risk a little bit and do a bit of a deep dive, but hopefully I'm going to come out the other end and show that some of the very challenges that we have to face as an industry can become the fundamentals of how we build incrementally successful practices going forward. So the idea must be, please don't leave halfway through the presentation. When I was saying to my wife Zelda a bit about this, she actually said, Andrew, it feels a little bit like a Jaws movie. You know, get in there, you're going to have this theme music coming, and then hopefully we don't get eaten to the process. But getting into some of the content and sticking with the shark theme, I suppose. The biggest risk that we now face in our insurance industry is climate change. It's a reality. In 2021, $270 billion worth of losses were incurred in the US alone, of which only 40% were insured. The biggest drivers of Cat 1 climate change issues remain hurricanes and earthquakes, but the biggest single driver of loss across the globe is in fact now flooding. And flooding is driven by a number of events. One is obviously just the increase in the number of weather events and cats happening, but it's the impact of urbanization, the economic exposure that's aggregating into cities, and then aging infrastructure around how you prevent and manage water in that space. Of course, fires, tornadoes, storms, drought, and then of course, the volcano eruption in Haiti last year, where 2,000 people lost their lives, tells their own story. But I found this particular slide harrowing. This is a report from Swiss Re of catastrophe events recorded globally over the last 30 years. The green dots across the top reflect the number of cat events recorded. The blue lines reflect the actual losses incurred with each cat. That's a 30-year view. It refers to a 10-year moving average annual growth rate of 5 to 7% per year. So the reality is it's here, it's real. And if we then had to take these next 30 years and go from 2020 to 2050, I can only assume that you'd agree with me that the likelihood of that graph is just going to get steeper. And we are, of course, not exempt from this catastrophe cycle and these weather-related events. We've seen unprecedented weather in our own country, with the rainfall really spiking up in the north in Q4 of last year. And then following through into Q1 of this year, we saw obviously the Durban floods, the biggest we've seen since the 80s. And then, of course, we have our own unique pressures that Graham has talked a bit to around some of the social dynamics. And the Sajri event is something that will remain, particularly in the KZN and Gauteng Saki, for a long time. And then the other big driver of risk must be cyber. And I know we talk about it and there's a little uptake, but the facts can't lie. Digital is going to become the way things happen going forward, which makes data the most important currency of the future. If data is the most important currency of the future, people attacking data to disrupt process flow, client value propositions, engagement processes, you name it, becomes our biggest risk, and we need to protect against it. In the South African context, our internet users are expected to grow about 12% to 65% by 2030. Digital is going to dominate all channel distribution, particularly in financial services. SA is already the most hacked country in Africa, with 230 million cyber detections noted in 2021. And of course, we know the African continent is all about mobile, right? That's the mobile revolution, that's data-led. And we know, for example, there are 577 malware attacks experienced every hour in that space. So picture your car. Your car is not trying to be stolen every second, every day, but your data assets are. And so fundamentally, this shift is significant. So this starts causing this perfect storm around an increasing risk base that we have to realize and then account for as an industry. And that perfect storm is in some ways made incrementally worse in the current economic cycle. Graham also has touched on the economy. And the good news is economics goes in cycles, so this too will turn. But right now, it's really exacerbating our position. In the SA environment, CPI is at 7.8%. That means if you want to be insured for the same value in terms of buying power next year, your policy must increase by 8% just to start. And you haven't accounted for any risk factors just driving that through. PPI has surged to 18%, which suggests that the CPI still has significant runway to grow. The rand, at the time I put this together, had devalued 23%, just under 24%, from the start of Q2 to 17.99, a devaluation of almost 24%. And then, of course, load shedding, soaring costs of food and energy, and key supply chain disruptions are things we inherently live with in our South African economy. And we are not unique, right? Because globally, we're seeing the same thing coming through. We're seeing slowdowns in global growth. We're seeing a huge inflation drive that Europe has not seen, America has not seen in decades, driven by soaring food and energy prices, but also the lingering effect of the huge liquidity that's come into the market, first to manage credit exposures, remember those days, defaults, and then, of course, to restart economies through COVID. And then add to that the war in Ukraine, and huge pressure on ESG, a big topic of today as well. It's becoming a very big focus of regulators. And all this is driving up insurance costs. Starting with the graphs on the right-hand side there, the first is the load shedding graph, and that's up to 2021. 2022, the load shedding exceeded 2021 in August already. So that just continues to spike and talks about the very significant energy crisis that we have. The graph at the bottom is precipitation levels in South Africa. Again, showing huge amounts of increase of rainfall, while some parts of the country, Eastern Cape, suffered drought, the north has been exceptionally wet. And that has driven a significant shift in frequency. Remember, insurance cost is driven by three things: frequency, severity, and average cost per claim. So frequency, we saw a low amount of cars on the road in 2020. It grew in 2021. 2022, we're back up above 2019 levels on traffic flows. We have power surge claims going to the roof as a result of the load shedding, and of course, significantly higher rainfall has spiked the number of building claims significantly, particularly up in the rainfall-affected areas. So frequency, definitely up. But coupled with that, severity is also significantly up. Severity assisted significantly in terms of vehicle theft. So vehicles that used to be stolen were these older guys, right? Now it's the more modern ones, because the theft is happening with the jamming of your keyless entry cars. The average value of a stolen vehicle in Santam is up 75% as that shift in terms of the cars being stolen starts flowing through. Collisions are happening at higher speed. We see also the reality in our economic environment, the decline in fire protection services, some infrastructure issues in local municipalities around our roads in particular, and then compliance with building regulations. So when last did you have a building claim that resulted from fire and you only had a partial loss? It tends to burn down in full. And of course, if we think about then the building regulations, a huge part of the Durban floods are attributed to in some ways, poor spatial planning. And on top of all that, we see the growth in the underlying average cost per claim, and that's driven to the supply chain disruptions that we all know about. Second-hand car values, it's a great investment class at the moment. We have a real bubble in second-hand car value prices, but of course, if you're in an accident, that flows through. Car hire days have grown, you've got rand devaluation impacting car parts, but also imported plant and machinery on a replacement value basis. And then, of course, just the impact of local and global inflation. The comment that you have to grow your base by inflation just to stay where you were last year. And then you've got this impact coming through in the reinsurance line like we've never seen before. So a significant reduction in reinsurer appetite, driven by a desire to avoid some volatility, impacted by the global uncertainties. Inflation pricing are impacting reinsurance pricing. We haven't seen that before. Sanctions with big exclusions coming through around certain lines of business and geographies that we can no longer support. And then, of course, the CAT programs in particular, the focus on occurrence definitions. And we're seeing those wording coming through in our treaties, and we're having to force those through into our wordings, and you will see that more and more in your engagement with your clients. So it really does come together as that perfect storm. So this is the part where you don't get up and go, because hopefully now we start talking about so what. So what do we need to be able to come through the significant shift in risk in a cycle that makes it incrementally hard for ourselves, yourselves, and obviously our clients? We argue we need three things. We need to find a way to drive financial stability and economic growth. How do you do that? You encourage lending. How do you get lending? You secure and you underwrite the risk to enable the lending to grow an economy. In order to get that sustainability in that lending and that risk transference, we need to find a way to contribute to safety and reduce systemic risk. McFarlane talked about we need to be able to invest and take ownership about how we privatize to some degree, but also take ownership of addressing those fundamental risk curves that risk destabilizing us as a country, as a company, and as a value proposition to our clients. And then, of course, we have to come together as a force for social good. There is no doubt that there is lots of capital in the world. It's how we apply those big capital pools and reposition them to make them of value to a client when the client needs them most. And that's the fundamental underlying principle of insurance. It's pooling of risk to make it available for people in their moment of need. Those three factors are the fundamental underlying factors of insurance. And that talks to the fact that we are in an industry where we have significant purpose and some real value to add. It's a great place to be. But having said that, it's not necessarily easy to manage through change. So how do we go through that? How do we realize our purpose and shift into a space where we can add incremental value? And I want to talk in two spaces, the insurer leg and then the broker, the advisor leg. On the insurer side, it's all going to become about the focus on data. Data is our new currency. We're going to get aggressive about trying to get the best data. We're going to spend money on machine learning and data scientists to really get insight, to rate the risk on the individual basis as we possibly can. Our models are going to fundamentally expand. Scenarios, not just a hailstorm on the N1 at 4 o'clock on a Friday afternoon in Joburg, but flood and sea surge, pluvial and fluvial. Fluvial is flooding that happens with lots of rainfall over a slow period of time that causes a river to burst its banks. Pluvial is rainfall that comes into a city urbanized area where there's no cleaning of drainage systems, and you create this urban issue and losses. And of course, sea surge with tides really impacting coastal areas. The new baselines, what is a 25-year event? What is a 50-year event? So the way that you'd cost this in an actuarial model is you say, what is that 50-year event going to cost us? And then I'll backdate it. If it takes 50 years, I'll put a premium in so that over 50 years I'll invest to be able to pay that. But are the 50-year events becoming 25-year events? When will the next big Durban storm happen? Do we really think it will be another 50 years, or could it happen sooner? And what does that mean for pricing? Then the long-term issues as well around sustainability. Most people say, oh, it's a VUCA world. You've all heard that. Can't plan more than 3 years. In this world, we have to think from an insurance and risk perspective, 2050, 2100. There's no doubt that we face some huge headwinds, but huge opportunities to deliver value going forward. And I think we'll see a lot more work being done far further out from a time horizon perspective. And then fundamentally, we have to start changing our risk solutions. The future cannot all be about transference. It has to be evolved to risk prevention and risk management leg with forecasting, preparedness, emergency response solutions and plans coming to the fore. In this world, advice has never been more important. Graham talked about it as well. The risks are becoming systemic and complex. The same product being sold for a higher and higher price to account for increased risk just fundamentally won't work. We need to be about professional risk advisory, and we need to understand new ways of managing risk. We think there'll be less space for pure middlemen. If your job is simply to provide a product for an insurer at a lower and cheaper price, there's another channel that can do that cheaper. Think call centers, think digital value propositions. It has to be about increased expertise, and it has to be about making sure you don't have underinsurance, making sure you get adequate cover, and you actually got protection for all the risks that you need. We think that there'll be a lot more partnership in placement and preparedness as we shift from product sell to risk management and engagement, and we lengthen that value proposition across multiple value points to the clients. Thinking again, preparation, cyber, flooding, fire, and this end-to-end risk management cycle going forward. Data is critical for the insurer. Argue it's critical for you. The partnership that we need going forward, insurers have these great actuarial models. They're doing machine learning. They've got all these things. You got the knowledge of the customer. We need to take and unlock that knowledge and work it together with the actuarial modeling capabilities of insurers to add real client value. And then, of course, the impact of regulation will continue as the regulators see this huge impact that can destroy economies and start trying to actively regulate into the space to ensure sustainability and build client confidence. So what will the intermediary of the future look like? And these, again, are just some thoughts. Please take them from where they are. We think there'll be increased specialization as you start driving focus around risk management, and that needs more specific realization of where exactly you have particular differentiators for your practice and can add values to your clients. So a focus on risk advice augmented by digital tools is going to be the baseline for the new successful practice. We think relationships with insurers will narrow. You'll have less insurers on your panel going forward, but those relationships will come deeper as we integrate more and offer more solutions across that risk curve going forward. I think that we all have to be digitally savvy. It is the new way of engaging with clients. We have to get our head around that, and we have to make sure our practices can accommodate that. And that's not just about the engagement of the client around sales and service and support. It's also very much about the integration with the insurer in the back end, so we take out duplication and work as a collective in offering solutions to the clients. Analytics and data. What data do you have in your practice, and what are you doing with that data, and what more can you do with that data, and how much more information can we collectively get around our client needs to drive up experience? And then lastly, being very clear about your value proposition and our collective value proposition as an intermediary market built around advice and risk management so that we stand out. Clients have more access than ever before to insurance knowledge and products. They are going to search before they're going to engage. So when they engage, they say, oh, but flip, that's insight, that's value. So that we need to be able to stand apart around advice going forward. So this then is my last slide. And I hope to try to bring it all together. So the first thing is we have to recognize as an industry, risk is growing. We are in a growing industry. We are in at the ground floor. If we can't get the response to a growing industry right, then who can? We're in a growth industry. Climate change and cyber are fundamentally driving up the base risk pool, creating huge opportunities for growth. We should never, ever before have to worry about growth again because the risk world is growing and the protection cost mechanism will be increasing, and we're in the ground floor, and we should be able to capitalize on this growth curve incrementally. In a South African context, it is really tough. We acknowledge that because it contributes to the fact that not only is risk rising, but our ability to manage and pay for it is incrementally tough. CPI at 7.8%, PPI at 30%, 30-year highs, rand devaluation greater than 20%, supply chain disruptions, load shedding, cost of reinsurance, all fundamental drivers of the underlying cost of claim. That talks to the sustainability of what we offer, but the opportunity to add incremental value, restructuring policies, being relevant to our clients, knowing what must be covered, what must be covered, realizing both sustainability of rate, but also the affordability of cover, has never needed an advisor more than it does today because of the importance of advice. And then, of course, the reality of reducing reinsurance appetite and the acceptance as an industry that there are certain risks we can no longer get cover for, and what that means, again, about the importance of advice going forward. But then moving across into the fact that we have real purpose. We work in an industry and an environment that makes a real difference like never before. We are the underlying driver and enabler of lending and economic growth. And when I put this together, grudge purchase. Seriously? We have so much real value to add. But it does, I think, require us to think very seriously about our approach to change. And we have to actively choose to see this as a threat, not just, apologies, as an opportunity, not just a threat going forward. We are one of the oldest industries in the world. When we first started insurance back in the 14th century, can you imagine they would never have foreseen the risks that we insure today? So we've seen this movie before as an industry, there's no doubt. We will be able to go through this change together. Absolutely, new solutions are required. The same products at high and higher prices just simply won't work. We need advice, we need risk management practices, we need a new way of engaging, we need digital, we need knowledge and expertise. But there's no doubt, in our view, that together we will not only survive, we'll use this fundamental shift in risk to platform us into incremental growth and incremental value for our clients, because we are in a great industry, and together we can do anything. Thank you very much for your time. That's me. Hope there's been some value.